Hi, good morning, everyone. So before we start our webinar proper, so there's some announcement to make. This webinar today will be our last webinar for the year. So for the next following weeks, we do not have any webinar in the whole month of December. So we will look forward to see you on the next year. So let's start. Okay, so before we start, today let's do some brief introduction. For stock council initiation, we have Lendlease Global, Fortress Mineral, and then we move on to Phillip on the ground. We have G.H.Y culture, Elite Commercial REIT, Oceanus, Biolidics, Eagle Hospitality Trust, and then lastly we'll move on to the SG Weekly to sum up the whole Q4 outlook in Singapore arena. Okay, without further ado, right now I pass my time to G.H.Y to share more about the Lendlease Global. Thank you. G.H.Y, to you.
Thanks, Aaron. Okay, so now moving on to Lendlease Global Commercial REIT, LREIT for short. Yeah. Okay, so just a brief introduction. LREIT's portfolio has two main properties, namely 313 Somerset, which most should be familiar with, and Sky Complex, a freehold office in Milan. 2 months ago, LREIT acquired a small stake in G.H.Y, a stable retail mall, which we believe that LREIT will accumulate a larger stake. And this is actually part of our thesis for our second investment merit. Yeah, but before I go into further detail, I'll just dive right into the 3 reasons why we actually like the stock. Okay, so first of all, in terms of the portfolio, we do think that this portfolio is a highly stable portfolio that is built to grow. So starting with Sky Complex, SC for short, SC is 100% leased to Sky Italia, which is owned by Comcast Corporation, the world's largest broadcasting company by revenue. The bill is long at 12.1 years, and the lease is triple net. Throughout COVID-19, this tenant has paid its rents timely and in full. Therefore, this asset, in our view, is very stable. Now, for 313, 313 is a retail mall located in the heart of Orchard. Although 313's rental structure comprised of gross turnover rent, GTO for short, historically, this GTO component actually accounts for less than 5% of LREIT's overall gross rental income. Amidst COVID-19, there were some impacts to the leases, which I'll elaborate further in a bit. But our view is, with footfall and sales recovering, it's likely that LREIT will negotiate leases on similar terms as before. So we are still expecting fixed rents to continue contributing more than 90% of the portfolio's gross rental income in 2022. The built-in rental escalations for both properties will provide the organic growth for the REIT. Okay, so earlier I mentioned that there were some COVID-19 impacts to the 313 asset. So if you look at the chart on your left, the revenue contribution from 313 for FY20 is lower than that of forecast. This is although the rental income that came from Sky Complex remains largely unchanged. The lower revenue recorded is largely due to the rental rebates that were provided by LREIT and the lower GTO rents received. For this coming year, we are expecting the drag from COVID-19 to be minimal. The reasons being, firstly, most of the mall has already reopened. And secondly, tenant sales and footfall actually already recovered to 70 and 60% respectively, as compared to in 4Q20 when footfall was actually at 20%. Thirdly, for this year, we are not expecting any more further rent abatements to be provided, as all of the abatements were actually flushed out in FY20. Arrears are also manageable, and lastly, no deferrals are confirmed under the COVID-19 Temporary Measures Act. So the anticipated drag, right, will actually come from the short-term leases that were provided, which will impact rental income for the year. Therefore, we are expecting this year's revenue and net property income to underperform IPO forecast by 3% and 7.5% respectively. Okay. We are also expecting the reopening of phase 3 to allow for a greater return of normalcy. So 313, as you know, is a lifestyle mall, a destination for youth. Its tenant mix are more on the F&B and fashion side, instead of the high-end or luxury tenants. So historically, 80% of the footfall is actually generated by locals. So with the reopening of phase 3, we believe the increase in group size and resumption of higher risk activities like your karaoke and nightclubs should actually help 3 see a greater return of sales and footfall. Although the Singapore-Hong Kong travel bubble has been delayed, we are still hopeful that more travel arrangements can be made with safe countries in due time. Okay, so the second reason why we like the stock is due to its strong organic and inorganic growth outlook. And apart from the rental escalations that I mentioned earlier, there are 2 key projects that we are looking at for organic growth. So firstly, the Grange Road car park redevelopment that is part of the government's plan to rejuvenate Orchard Road. This car park will become a multifunctional event space with cinemas, local hawker stores to provide locals and tourists with a first of its kind lifestyle experience along Orchard Road. This project is set to be operational by 1H 22, and the return on investment for this project is expected to be 10%. We are expecting this project to provide FY22 FY22's DPU with a 1% accretion. Okay, the second project is the AI to increase plot ratio for 313. 313 has been granted an increase in plot ratio, resulting in a potential increase of up to 1,008 square meters of space. However, in light of the current environment, REIT decided that it's better to delay major AEI works such that footfall and sales won't be too impacted at this point in time. We are looking at a possible delay till FY22 before we can see a valuation uplift for this project. Okay. So in terms of inorganic growth opportunities, we do believe that LV is poised to grow with the help of the sponsor, Lendlease Group. So just a bit of background, L Group is actually one of the largest developers in the world with a global pipeline of close to 113 billion and funds under management of 36 billion. LV is said to be the only REIT that Lendlease Group will have. Therefore, we believe that LV will actually benefit from the ROFRs offered by the sponsor. Now, having said that, LV has a few considerations when evaluating an acquisition opportunity. So, in a nutshell, it will only consider stabilized retail and office properties that are generating rentals at market rate, and there should also be no upcoming AEIs for the next 2 years. So going back to the pipeline, the assets in Australia and Asia are more stabilized for consideration. Also, 90% of the funds under management are office and retail assets. So if we narrow down this pipeline, we do think that the total pipeline that LV can benefit will be narrowed to 32.4 billion. Okay, so a bit more about G.H.Y and its recent acquisition. G.H.Y, as most of you know, is an integrated office and retail development in Jurong. It is one of the largest suburban malls in Singapore. It also comprises of 12 levels of office spaces, which has been 100% leased to the Ministry of National Development for the next 30 years. So in our view, G.H.Y is actually a stabilized asset with high fixed recurring income. On 1st October, LREIT purchased a 5% stake in Lendlease Asia Retail Investment Fund, AV3 for short, which holds a 75% indirect interest in G.H.Y. This brings LREIT's effective stake in G.H.Y to 3.75%. The 45 million cost is fully debt funded, and the ROI, the return of investment, is at 2%. In the near term, LV is actually looking at acquiring more stake in G.H.Y. The Lendlease Group still holds a 15.1% stake in that fund. Yeah, so this is actually one of the key acquisition opportunities that we are looking at. Sorry, yeah, thank you. Okay, so other probable markets to be evaluated include Australia, where LV sponsor has a significant presence. LV is also looking at third-party transactions in Europe. So with pro forma gearing of 37% post-acquisition and a low cost of debt of less than 1%, we see room for LV to pursue more acquisition opportunities. Okay, so valuation-wise, we still think that it's attractive. LV is currently trading at 20% below book, as compared to its diversified retail peers that are trading at 10% below book. REIT's forward dividend yield is also higher than the average forward dividend yield for diversified retail REITs at 6.1% versus 5.2% for FY20 or 21. In terms of key risks, the portfolio is small and the NPI is largely reliant on the Singapore retail market. So given that the leasing demand is expected to be subdued, and there may be competition to attract and retain quality tenants, we are expecting rental reversions of negative 10% for the year before recovering to 5 and 10% in FY22 and 23. Similarly, limited growth in rent escalations are expected for Sky Complex. We are expecting rents to stay flat for the next 2 years before a potential 3% rental uplift can be seen. Hence, to conclude, we are initiating coverage on LREIT with an accumulate DDM target price of 78 cents. At current price, we are looking at 6.1% yield and a total upside of 14.2%. Yeah, this is it for Lendlease REIT. Now we'll be moving on to Elite Commercial REIT. Yeah, this is our Phillip on the ground update. We have a webinar with them recently. So this is just a consolidation of some key highlights. And just a disclaimer, we do not have any coverage on this counter. Okay, so as a brief intro, Elite is a UK-focused commercial REIT with 97 assets, mostly freehold and leased to the government. Its main occupier is the Department for Work Pensions, DWP for short. This tenant is a uniquely counter-cyclical tenant, as is mainly responsible for pensions, child maintenance, welfare, and others. Yeah. So basically, when the economy is bad, these officers see more traffic. In terms of their lease structures, their leases are all cheaper net. It also has a long WALE of 7.6 years with annual rental escalations linked to CPI. Their next rental review will be expected in 2023, where we will see 8% uplift from their 2018 rents. Amidst COVID-19, this tenant has been very timely with rent payments and paid their rents in full. Actually, all tenants, I think. Yeah. So the manager has actually removed some of the break options within the current leases. Hence, valuation uplift for several properties are expected. Increased unemployment in the UK has increased the long-term need for DWP, as the UK saw claimant counts reaching to new highs, if you can see from the chart on the right. The DWP is expecting to double the number of work coaches by March 2021. Therefore, more space is actually expected to be needed. An interesting question was raised during the webinar, so I'll just elaborate a bit more. Given that DWP is a counter-cyclical tenant, what does this mean for the REIT when the UK government, when the UK economy recovers? So first of all, Elite is actually not expecting a quick recovery for the UK. Like the GFC recently, the unemployment numbers actually took 1 to 3 years to dwindle down. Secondly, 60% of their claims are actually for pensions, and with the UK's population aging, pension claims will likely to be relevant for many years to come. Therefore, Elite's management do believe that this 60% will be the floor for the REIT. Okay. Elite also touched on their recent acquisition deal and the merits of it. I have touched on this previously in the latest video on the ground for them, so I won't spend too much time. Basically, they are acquiring a portfolio of 58 freehold commercial properties which will be leased to the government, like their initial IPO portfolio. This acquisition will bring in greater geographical and tenant diversification, as the new portfolio introduces London assets, which has higher value and growth potential, while bringing in other UK government occupiers. This transaction is expected to be funded by debt and equity, and showing some skin in the game, the vendor will take up 89 million worth of consideration units at a minimum price of 68 cents, and Elite will take on 96 million in borrowings at an average cost of debt of 2.5%. The remaining 30 million will be either funded via equity, should market conditions be more favorable, or debt funded via vendors' loans and borrowings. Post-transaction, we are looking at an increase of 57% in terms of their market cap, along with a 3.2% DPU accretion. This is assuming that the transaction is financed through the issuance of consideration units and a 30 million equity fundraising. This is all from me. Now I'll pass my time on to Vivian for Fortress.
Thanks, G.H.Y. So I will be covering about Fortress Minerals. Next, please. Okay, we initiate Fortress Minerals with a buy recommendation at a target price of 27.5 cents. So to start off with a brief background about the company was listed on the SGX Catalyst board in 2019, and they are an iron ore concentrate producer in Malaysia, with FY19 being their maiden year of commercial production. So they explore, mine, produce, and sell this magnetite iron ore concentrate with a TFE grade of at least 65%. And the TFE here implies total iron content by mass. Its mining concession is located in Bukit Besi, Terengganu, Malaysia, and you could refer to the map on the right for the approximate location, while their business operations are mainly located in Kuala Lumpur. As of August 2020, there are 7.18 metric tons of iron ore reserves, and the mining rights were granted to Fortress until 2033. You may wonder what exactly is this iron ore concentrate. So iron ore is a key ingredient in steel making, and steel is the world's most commonly used metal. Fortress Minerals sells primarily to steel mills in Malaysia and China, but they have been putting more focus on the Malaysian market. The iron ore prices are benchmarked to the Platts Iron Ore Index, IODEX for short, specifically the prices for 65% iron or Fe, CFR North China. So for my presentation, I'll be referring to the few units as shown in the bottom right table. MT for metric tons, DMT for dry metric tons, and WMT for wet metric tons. And the difference between the wet and dry metric tons is that an approximate 10% reduction is applied to adjust from WMT to DMT for the moisture content. So WMT is usually quoted for production, while iron ore prices are based on the DMT. So next, please. There are three reasons why we recommend Fortress. First of all, we expect a healthy volume growth of 40% for FY21 to meet the increasing construction demand in Malaysia. This is supported by the fact that in the first half of financial year 21, production volume surged 57% year on year. And adding on to that, Malaysia's 9-month 2020 production of iron and steel bars and rods grew 5.5% year on year. On the basis of projected GDP growth of 6.5 to 7.5% and construction sector growth for 2021 to be 13.9%, and these figures are released in the Budget 2021 announcement by the Malaysian Ministry of Finance, the demand for steel and iron ores is expected to increase. Next. The company enjoys high profitability due to low cost structure and proximity to their domestic customers. So for financial year 20, they recorded a unit cost of $28.81 per wet metric ton, WMT, against an average realized selling price of $95.93 per DMT, dry metric ton. So from here, they yielded a gross profit margin of 66.7%. Another advantage that Fortress Minerals has is the close proximity of its Bukit Besi mine, which is about 100 kilometers to its domestic steel customers, and you could refer to the map on the right for a rough idea of the distance between the mine and the domestic steel mills. So if we were to raise an example of a domestic steel mill, a Malaysian steel mill, purchasing iron ore from the Australian iron ore producers, the delivery time would take around 10 to 20 days for the iron ore to be delivered to these steel mills in Malaysia. And as compared to the daily trucking services that Fortress provides, I believe that all these factors are expected to ensure captive buyers from steel mills in Malaysia. Next, there is considerable exploration upside potential with 5% of the concession area explored. Of the total concession area of 526.2 hectares. So this equates to about 640 football fields at Bukit Besi mine. The remaining 95% of unexplored concession area proves that there is substantial potential for mining as larger tracts are explored. And as mentioned earlier, the mining rights granted will only expire in early 2033. Next, moving on to the risks that the company may face. So COVID-19 first disrupted their business operations when the Malaysian government implemented the Movement Control Order, MCO for short, and the mine was ordered to suspend operations from 18th of March to 29th of April this year. More recently in Malaysia, there was an outbreak of the virus in a workers' accommodation, which led to widespread infection. For Fortress, the company's business operations are highly dependent on local workers, some of whom actually reside in the staff dormitories. So any further containment measures introduced by the government or even infection within the company may result in suspension of operations again. Next, the company's revenue is directly impacted by iron ore prices. So a little bit of context on the global iron ore market. Australia and Brazil are the biggest producers, and China is the biggest importer of iron ore, taking up about 70% of the total iron ore market. So recently, iron ore prices have reached a 7-year high on shortage in supply from Brazilian and Australian iron ore producers, coupled with the surge in demand from Chinese steelmakers as the Chinese government pushes an infrastructure-led economic recovery. Looking forward, prices are expected to fall with supply recovery in sight as iron ore producers in Brazil and Australia step up the production with news of stronger iron ore exports recently. So other than that, demand from Chinese steelmakers will continue to be robust, even though recovery will be slow for other countries. This should keep prices above $110 per dry metric ton DMT. Next, moving on to financial highlights and forecasts. Firstly, the revenue is calculated based on the volume of iron ore sold multiplied by the average selling price, which is benchmarked to the IODEX 65% FE-CFR North China. Net profit for first half of FY21 was higher than the total of FY20, owing to the increase in volume of iron ore sold. So as you can see from the top right graph, the first half FY21 sales volume surged 57% year on year. Next, we estimate the volume and revenue growth for FY21 to be around 40%. For revenue will be increased to US dollars 36.4 million, as shown on the table on the right. This is on the assumption that sales volume is maintained at levels prior to the surge mentioned. We believe moving forward, gross profit margins would continue to improve. As for assets, the company's fixed assets doubled from FY18 to FY20. So this proves that Fortress Minerals has ample facilities to deal with increase in production volume. Next, for valuation, our valuation is done based on the PE ratio, 11 times of FY21 PE ratio, and this is in line with the industry average. So to conclude, we initiate Fortress Minerals with a buy call at a target price of 27.5 cents. So I'll be now passing on the time to Terence.
Thanks, Vivian, and good morning, everyone. We provide a summary of G.H.Y Culture and Media, which launched and registered its prospectus last Friday to list on the SGX main board. So in this slide, we provide a summary of their offer details. You can see this we summarize this in the table here. So they are offering a total of 21.7 million shares rather. This excludes the 140 million shares that they've already issued to the cornerstone investors. We'll talk about them later. But this share offering here, 21.7 million, will raise about 14.3 million. In total, they'll raise about 105 million Sing dollars. So the purpose of this offering is to they set aside for 60% rather of the total amount raised for the expansion of TV program and film production business, and then they do investments in production, acquisitions, JVs, and other strategic alliances. 20% is expected to go into the expansion of their concept production business via the investment in production, acquisitions, JVs, and also strategic alliances. Then 14% will go to working capital, and the rest of the amount raised, 6% will go towards the listing expenses. So that's about 6 million. Key dates for the IPO. 11, they like we mentioned, they launched and registered last Friday, 11 December, and so the public offer actually already opened last Friday at 9 p.m. The closing date for the public offer is on the 16th of December at 12 p.m. So that's Wednesday. And the shares are expected to commence trading on a ready basis on 18 December at 9 a.m. So you just open on 18 December, Friday, this Friday. We also show some of the cornerstone investors. We put as selected because there are few, so we just highlight some of those main ones. So they have Epical Entertainment, ICH Capital, ITE International Singapore, OCIM International founder Ron Sim is in as well, and then Chilin Asset Management form the bulk of the cornerstone investors. For G.H.Y, they don't have a dividend policy. No fixed dividend policy, but they've guided to recommend 30% of NOPAT, not net profit after tax for financial year 2020 and financial year 2021. It's important to note for the 30% for financial year 20 excludes the dividends that they already distribute prior to the IPO, which is a common practice. So in our next slide, that's some background on G.H.Y Culture and Media. So they are entertainment business that focuses on the production and promotion of dramas, films, and concerts in the Asia Pacific region. The business model, for some of you who are familiar, is a bit similar to like MM2 and Unusual. So you can see this infographic on the left side. You can see TV programs and film production. They do the production and co-production of dramas and films. You can see the infographic on the middle. You can see some of the past productions that they have released. The Little Nyonya, Dance of the Sky Empire, Perfect Village, Frontliners as well. In terms of concert production, they have the rights for some of these artists. So they have the rights to undertake the production of concerts for G.H.Y in Singapore, Malaysia, Australia, Thailand, Japan, and also China. And these contracts, as we understand, are entered into with very long-term basis. Some don't even have any expiry, so it's like perpetual. They as long as he will do a concert, they have the rights to do his concert in these countries. And then these two TV program and film production is about 55% of their revenue, 55-57% of FY19 revenue. Concert production about 35%. Then the rest, talent management and costume, props, and makeup services, very small. That's 10%. So TV program and concert production is their biggest. So in our next slide, we also show some of the audited financial statements that they release. This slide, thank you. The financial period, you can see here, financial period 2018 is not meaningful for comparison with financial year 2019. The reason is because financial period 2018, you can see here FP 2018, they actually just established this company. So I mean established as in they formed the structure. So you can see just 3 million. So it's not comparable. So the one that is really comparable is financial year 2019. So the better way to compare should be 6 months 2019 and 6 months 2020. You can see for 6 months 2020, revenue actually dropped slightly by about 4 to 5 million. The reason for the drop is because of the absence of their concert production. But because of that also, the cost of sales actually dropped. And you can see gross profit for 6 months 20 is actually 19 million. So it's about 8 million surge. So when we distill this down all the way to the profit for the period, you can see profit for the period is actually up about nearly 2 million versus 6 months 2019. So stronger performance for 19 for 2020. In our next slide, our last slide, we have 3 investment merits. These investment merits are not by us, but these three investment merits provided by the company. But so the first investment merits is the ability to produce high quality and well-received dramas and films underpinned by their strong and talented script writing team and end-to-end production capabilities. So again, this is very similar to MM2. What they do is they do the script writing, the production of the film. Of course, MM2 got the cinemas but they what they're saying is, you can see in investment merits too, they have very strong network of business relationships and lasting partnerships with distributors and other working partners in the media and entertainment industries. So they like G.H.Y. So they capture all the value. What they're saying is they can capture all the profit rather in the whole entire value chain. Okay, then number three, they are actively growing their portfolio of artists to contribute to the success of their concert production business. Okay, so that's all from me for G.H.Y Culture and Media. That's a recap. The IPO is expected to close. The IPO for the public offer is expected to close on this Wednesday at 12 p.m. That's all from me. I'll pass over to Timothy, who will cover Eagle Hospitality Trust proposed new REIT manager. So Timothy, over to you.
Yeah, thanks, Terence. This is just an update, Phillip on the ground for Eagle Hospitality Trust. So they just recently did a webinar with us. So just an update on the business itself. Their shares suspended trading on the 24th of March this year. This was due to a few reasons. One reason was that various master lessees underwent some delinquencies, and there were defaults and terminations of their hotel management agreements and franchise agreements. And there were also acceleration and notices of defaults for their loans. So they also defaulted on some loans. And lastly, they have some breach of regulations as well. So potential liabilities for interested person transactions and unauthorized paycheck protection program loan applications. For operations-wise, 15 of their 18 hotels remain closed at this point in time. So in light of the breach of regulations, MAS actually issued a direction for the Eagle Hospitality Trust to remove their current REIT manager by the 30th of December this year. So in light of this, Eagle Hospitality Trust proposed a new REIT manager to replace this existing one. The new one they have proposed is by SEC PRE Hospitality REIT Management Private Limited. This company is part of the SC Group with a 16-year track record of managing and managed 2 listed REITs in Asia, G.H.Y and T Prime REIT, with total AUM of more than $7.3 billion. So with this proposed new REIT manager to replace the existing REIT manager, an EGM vote will be held on the 30th of December, 2 p.m. for all Eagle Hospitality Trust shareholders. And there'll be 5 resolutions for you, for the shareholders to vote. Okay, so these resolutions will determine whether this new REIT manager will be appointed, or if it's not appointed, then whether or not this REIT will be wind up and delisted. So the resolutions are as follows. Resolution 1 is the proposed appointment of the REIT manager. Resolution 2 is the proposed base fee structure for the new REIT manager. We will touch on that later. Resolution 3 is for the proposed appointment of the new trustee manager and waiver of the requisite notice period. So it's just basically some waiver or some requisites for the new REIT manager to come in. Resolution 4 is a proposed authority for issuance of additional 140 million new shares for the payment of the base fees for the new manager for 2 years, FY 2021 and 2022. The reason for this new shares issuance is because the REIT currently now is generating losses, and they don't expect any operating income for quite an extended period, mainly because their hotels are still closed at the moment, and also because they have a lot of loans to pay off still. So that's why payment for the REIT manager fees will be paid in shares instead. So it helps the REIT to sustain operations at this point in time without additional strain on cash flows. And the last resolution is resolution 5, which is the termination proposal. So basically, Resolution 1, 2, 3, and 4 is needed. Approval of 1, 2, 3, and 4 all must be approved in order for the new REIT manager to come in and for the business to be able to continue. If either one of 1, 2, 3, and 4 is not approved, then the new REIT manager will not come in. And if that is the case and resolution 5 is approved, then the REIT will basically go into winding up and will be sold and the proceeds paid to shareholders. So we came up with 3 scenarios, outcomes of this EGM. Next slide. Next slide, please. Okay, no. Okay, so there are 3 scenarios that can come out of this EGM. So firstly, like I mentioned, resolution 1 to 4 are all approved. So the new REIT manager will be appointed, and Eagle Hospitality REIT will be renamed as SCCP Hospitality REIT. The strategy of the new REIT manager will be firstly to mainly to reopen the hotels. So what they will do is that they will have Eagle Hospitality Business Trust to be the new master lessee to replace those delinquent ones. And also they work with the hotel managers and franchises to help to open their hotels as well. A new financing will be provided also. They will try to get new financing as well. So this is conditional upon the appointment of the new REIT manager. So 125 million proposed bridge facility will be raised to fund capex and working capital of the REIT for it to continue operations. This new financing will mature on the 30th of June 2022 with an 18-month extension, conditional on the following criteria: sale of certain properties in 2021, minimum equity raising of 20 mil and 30 mil in December 2021 and 2022 respectively, and the resumption of EHT's shares, trading of the shares before 31st September 2021. Okay, so like I mentioned just now, management fees will be paid as new shares for the first 2 years. So 140 million new shares, representing up to 16% of existing shares. This will have dilution impact on the share price as well. And further equity raising is expected in addition to all this. This is because current leverage for Eagle Hospitality Trust is 65.5%, which is significantly higher than the MAS waiver, the MAS 50% limit, which they are seeking a waiver for at the moment. So in order to pay down this debt, they are considering also further equity raising. Okay, scenario 2 is either one of resolution 1 to 4 is not approved and resolution 5 is approved. So what will happen is there will be a voluntary delisting of EHT, a termination and winding up of the company and potential sale of assets. So, but from this, we can see that there's a high chance that there'll be minimal to no distribution to shareholders, mainly because there's a total liabilities of 630 million compared to the total assets of 778 million. So considering the weak market now still at the moment, the assets could sell at discounted prices, coupled with recurring operating losses. So that there may be minimal to no distributions left in the scenario of winding up. The last scenario is all resolutions are not approved. So there's no resolutions approved. So this will end up, they will seek insolvency protection and they will start winding down the company. So because they won't have the new financing to carry on operations, so they'll have to start winding down. So in light of this, our recommendation would be to go with the approval, at least because then they'll be able to get the additional funding and possibly allow the assets to reopen and maybe revalue upwards as the economy opens up. So at least still have some chance for growth and also investment recoup. Okay, so this is just the summary of all the EGM resolutions 1, 2, 3, and 4, and 5. So on the right hand side, you can see the voting threshold. So they need at least 50%, 75% for certain resolutions, and they will need 1, 2, 3, 4 to all pass to all be approved in order for the new REIT manager to come in and the new financing be provided to the REIT for continuing operations. So this is just a timeline for the EGM on the top side. So for the timeline is on the 18th of December, Friday, 2 p.m. is the deadline for CPF and SRS investors to approach their banks to submit their votes for them. On the 23rd of December is the deadline for submission of questions on resolutions to Eagle Hospitality Trust. And 27 December, Sunday, 2 p.m. is the deadline to register for the EGM and to submit your votes via post or by email to that specific email. And on the 30th of December is the EGM itself. It'll be hosted online as a webcast. There is also a SIAS Eagle Hospitality Trust virtual dialogue session held on the 17th of December, Thursday, 5 p.m. It's for current shareholders of EHT to submit your questions and for management to answer your questions. So if you're an existing shareholder of EHT, you can RSVP and submit your questions by 14 December, which is today. Actually, it's now 12 p.m. to SIAS at this link. You just have to provide your full name, 4 digits of NIC, contact number, email address, and an electronic copy of proof of staple security holdings to show that you prove that you have the shares, so that you can attend this virtual dialogue session with Eagle Hospitality Trust. So that's all from me. I'll pass my time on to Paul.
Thanks, Timothy. Just a reminder, today will be our last webinar for the year. I think we'll resume in early January. Next slide. In terms of the macro, there wasn't really any major macro news, especially in Singapore. But one macro data point that kind of caught our attention is, of course, the record high rates for containers. So it's a boom time now for container shipping. So what we see is that when we look at the most recent data in terms of the imports, so TEUs are the amount of containers being imported through LA, Los Angeles port, is up about 30%. So this is a huge number, and this is a record high amount of containers. We'll show you the chart later. Then later on, I'll just discuss on the Oceanus Poems webinar that occurred last week. Just some highlights, and also we released a note on Biolidics. It's non-rated. It's just a Q&A that we had with them in terms of some of the new antigen rapid test kit that was launched by them. In terms of our view, our tactical views, I think there is a bullish setup for 2021. I think the economic momentum looks strong. We will get this reopening bounce, especially last year we had circuit breaker and a shutdown. So year on year, you're going to have a very strong year. Not to mention wealth effect is probably more in the US rather than Singapore. And then we have a pent-up demand, especially for services. So there is strong tailwinds for in terms of the economy. Then when revenue starts to recover, we will get a big earnings rebound from operating leverage for most businesses. And of course, this is specific to Singapore. I mean, we have valuation support, and especially when the interest rates are even much lower than before we entered COVID. So technically, we were probably bullish more on the cyclical stocks, especially on commodities. Weeks ahead, I think you can read the one interesting one. One interesting one will be the U.S. Electoral College. So this will be officially when the states actually vote. I mean, in terms of the legislation, this is where they officially cast their votes in terms of who is the president. So this is an important milestone. The other things, I think there's a FOMC meeting. Then probably the other news that could create some momentum will be the FDA will be meeting on the 17th for the Moderna vaccine. So that could be another thing that could maybe spur the market. In terms of webinar, the next 2 weeks, obviously there's none now, everyone's on leave, but we will have our first webinar, first read on the 6th of Jan. I don't think it's in the poems yet, but I mean, if anyone's interested, feel free to register, because they will be discussing about like we discussed last week, the whole restructuring of their master lease agreements. We will also have our quarterly strategy, first quarter strategy on 9th of January, Saturday morning. So if you do have time, feel free to register for that. I don't think it's in the poems yet. Next slide. As usual, we will just run through the COVID cases. The numbers are bleak. I think the global cases is continue to rise. I think we thought there could be some tapering down, but it seems to be rebounding. We have a new high of about 600,000 a day. And you know, the 7-day moving average is 618, but the current number is 692, so it means it's still on the upward trajectory. In part, the reason is because in the US, the cases are surging, as you can see from the orange line. In terms of Germany, we don't have the German numbers, but we can see that most of the countries are tapering down, but Germany actually entering into a hard lockdown. I guess it's their version of circuit breaker on the 16th of December, where where all non-essential stores will be shut. So this thing is not over. I mean, it's still happening and still raging. And even Germany, you know, the largest economy in Europe, is also facing it. Next slide. I mean, the bad news here is, of course, in Asia, so whatever expectation we have on borders opening, I think we probably have to taper it down. I think you can see in Japan, the third wave is a record high. You can see the red line continues to surge higher in Japan. Likewise in Malaysia, although it's come off, but it's still at elevated levels in the orange line. And you can see the blue line, South Korea, also touching a record highs. So I mean, any international, the borders will remain shut for some time, I guess. Next slide. In Singapore, these are our Singapore numbers, and we are doing great in that sense. I mean, especially when you compare to other countries. We had 0 community case in the past 8 days. And even in the dorm, we only had 1 in the past 10 days. So it'll be interesting later on this evening when the Prime Minister kind of makes some announcement. Next slide. Okay, this was the one that I just wanted to highlight. If you look at the red line, so these are imports. That means the amount of containers that goes through the USLA. You know, if you're shipping anything from China, obviously you use the USLA port, is the biggest one. So you can see that it's a record high. The actual absolute numbers you can't see from here, but it's about 700 or 800,000 containers last month. So this is in September, sorry, in October, I think. In September, sorry. So these are record high. So it's very strange that we are in so-called recessionary conditions, but record high in containers. So the container rates, when you move any container from Asia to US or Europe, is a 10-year record. If I'm not mistaken, could be even record highs now. But and also there's also in the background there's also shortage of containers. So these are that means the cost to ship a TEU from Asia to Europe. And part of the reason is the goods economy. There's also some stockpiling of PPE and so forth. But I guess with consumers shifting their spending from services, not less entertainment, less travel, and all going to goods economy and e-commerce, you see this huge pickup in import activity, which is quite an interesting data point considering the weaker economic backdrop that we are facing. So you can imagine when the economy turns stronger, I wonder how these numbers will go. I'll just run through just quickly on our Oceanus Poems webinar. So the market cap is 600 million, latest number. They registered a 1 million net profit in third quarter 20. So you can do the maths. So the past 2015 to 17, what they've done was they clean up the balance sheet. Even the accounts were qualified. But everything is back to normal. So the auditors have kind of approved the accounts, and then the next 2018-20 was for them to build up the business. So right now there are 4 key businesses, but let me just focus on the main one. So right now the business that contributes the most revenue is from the distribution business. It comes from this company called Season Global. So they are a South China company, and they are a major importer of FMCG, be it alcohol, beverages, and milk. So that's contributing most of the revenue. In terms of moving forward, the 2021 to 2023, the food tech strategy that they have, the main thrust is this thing called the Oceanus Food Tech Hub. The plan here is to provide intensive farming. For this particular case, is pond farming in the urban setting, especially right now where food security is such a big issue after the recent COVID event. So what they're doing is they're going to supply the technology management skill, and then the actual physical property will not be owned by them. It will be owned by a third party. So the first project they have is in Hainan. But more importantly, they are building one project as a commercial proof of concept, a pond farming project in Tuas. It's under the Universal Aquaculture Project. Okay. I'm just sharing with you all the highlights of the meeting. The next will be the Biolidics. Again, all these are non-rated, but because they launched an antigen test kit, and we just did a Q&A with them, not just for a report, just for everyone's understanding where they're coming from. So they launched in November, they launched this thing called the antigen rapid test kit, distribution agreement with a Chinese company called G.H.Y. So with this antigen test, the second bullet point, they actually receive a provisional authorization from the HSA. I did go through the HSA website. I think there are 6 such antigen, roughly. I'm just manually counting. There were like 6 antigen tests that was approved. So, but I think the bigger market they're targeting is for Philippines. So, antigen test, for those who don't know, I think before any major event, I think in Singapore they're trying to push for antigen test because you get a very quick, you will get a very quick result, and then it's better than antibody test because it actually tests the protein of the virus, not the virus itself, but some of the proteins of the virus. And I think for Biolidics, the key market for them is Philippines and Indonesia, because you can see that part of the agreement is that they become an exclusive distributor if they meet like 100,000 sales in Singapore, but in Philippines they need to hit 1 million. So obviously the bigger plan is Philippines and even Indonesia. And also one of the things that they wanted to highlight was that it was recommended that to have an antibody test before any vaccination to prevent this thing called VAID. Basically, I think very little written on it, but what it means is that if you have the antibody, there's a possibility that, and you get vaccinated, your condition may actually worsen. Again, I have really no idea. I'm just reading off from the literature. The other kit that they are looking to launch is this thing called neutralizing antibody kit. So it's a more precise measure of the antibodies that actually can give you immunity, and from their point of view, it will be useful after the vaccination to ensure whether the immunity levels are still there. Because right now, as we all know, even though you get the vaccine, the level of immunity is still unclear. But if you have this test kit, I think you can pinpoint to the exact antibody that can help prevent the spike protein, I guess. Next slide. I think that's the end of it. And thank you for everyone for listening. I think we can proceed to Q&A. Okay, let me just take the first question. Okay, I actually did. Okay, this is quite a long question, but let me just cut it short. And okay. So the question. Thank you for the question. I think is very interesting and good that you bring it up. So the question is the book value, which SIA, because SIA officially states the book value as 514, whereas if you take into account the MCB, the very complicated instrument that they issued, the mandatory convertible bond, the book value is 357. So thanks to this question, we actually did ask SIA. Actually, we post the question and answer in our website. If you go to SOX BNB under the community, we actually posted there. So what they replied to us was, in a way, you're right. Is that it's like have your cake and eat it. So this again, so sorry if I'm confused, everyone, but this mandatory, that's roughly the numbers. There's 2 billion of these mandatory convertible bonds. Correct me if I'm wrong, I don't have the precise number. So 2 billion. So these are part of equity. So that means it's considered as book value, but the number of shares doesn't really reflect. So this 2 billion is when they calculate that 514, it doesn't include that. And the reason why they give is that there is an option, because it is up to SIA whether they might, because SIA has the option to redeem. So I wouldn't say the trick, but the disclaimer here is that they cannot consider these 2 billion MCBs as shares because they have an option to buy it back. So technically, they can actually say that I can buy this back. So these are not necessarily ordinary shares. Whereas if this was mandatory, this was a convertible where you cannot redeem, then you have to calculate the book value according to that extra 2 billion shares. I hope I don't confuse you. I know it's a bit confusing. So the issue is, should you include the 2 billion as shares, or should you just put it in equity? So they're not including that as shares yet because they said on paper, they have the right to actually redeem these MCBs. Yeah, so it's a very long answer. So all I can say is it's a very nice have your cake and eat it kind of instrument, because you don't, the number of shares, you get the benefit that the 2 billion becomes your equity, but the 2 billion doesn't become a number of shares because you can actually buy back the convertible. You can buy back these convertible bonds, which I mean I am not highly unlikely. I mean, who wants to? Yeah, I mean you are, even you have so tight on liquidity, and I mean, would you want to actually buy back? But again, no, we shouldn't speculate on that. But officially, that gives them the right, so that helps them not to. That's why. It's up. I mean, in reality, it depends whether you want to convert. So, in reality, it should be. You could also argue that it should be 357 and not 514. Yeah. So thanks for that. We actually posted the exact email we sent, and thanks to SIA. I mean, they are very graciously to reply. So if you go to our Stocks BNB website, there's a community page, and we actually posted the exact. Because I we can't post this thing as a mass email, so that was the only place we could. So if you refer to that, you will get the exact email that we sent and the exact reply. I mean, for full transparency, and they're very nice of SIA to actually reply to us. Yeah, I hope that answers the question. And thanks for it. Kind of clears a lot of things. I think you want to move on to the TA first. Let me go look for that community page. Yeah, Viren.
Hello. I think I'll take over from Paul. I think you just take the other question and let the TA do all together at once later. So there is a question whether the 3 local banks' profit might be affected mid to long term by more digital banking licenses. Right now, right now because we are just seeing that the new entrants just got their licenses and they are only expected to become operational in 2022. Definitely. What we are seeing is that in the short term, definitely we know that this won't be a threat to the local banks. But moving forward, actually from my understanding, additional digital banking licenses should only be offered to the digital wholesale bank, applicable to the wholesale bank and not to the digital full bank, at least as of right now. So it really depends on what the digital wholesale banks can come up with. Because I think for wholesale banking itself, the whole industry is actually quite competitive itself. So the new digital, because unlike your digital full bank, whereby like Singtel, Grab, they can offer you some of the stuff that are on their main platforms through Grab and Singtel. When you are wholesale banks, you're usually dealing with like trade finance loans. And for trade finance loans, the only way you can outcompete each other, apart from lowering your interest rate, which is very unlikely in this low interest rate environment, is to actually make your processes faster and stuff like that. So it really needs to see the development within the wholesale banking sector, how the new entrants are able to disrupt the sector. And I do not think that anything that they come up with, I think the local banks will be able to easily catch up in terms of technology, especially with all the investments that the local banks are currently undertaking. And in terms of profit wise, if you take a look at how, just give me a moment. Okay, so sorry. Okay, so for that, in terms of profit wise, if you take a look at all the digital banking licenses around, a lot of the digital banks are not profitable as of yet. You can probably find only a handful among the hundreds of digital banks that are around. So in terms of directly cutting into the profits of the local banks in their main business segments, I think that's quite unlikely in the short term. Even over the mid to long term, there needs to be a lot of investments to be done to actually turn profitable. Yeah, and that's it from me for the local bank side. Let me see where. I think I'll hand the time back to Viren if you're ready to take the TA questions.
Yeah, so okay, sure, no problem. Okay, so let me share my screen first. Okay, so here you go. Okay, so the first question is, I think the most rated one is Riverstone. Okay, so Riverstone actually last week, I think the last 2 webinars I shared on Riverstone, I think someone asked as well, is that Riverstone actually has a very, very huge potential to hit even lower for now, for now. So first of all, after the first wave completed already of the I think it was a primary phase. Okay, so we are facing a correction, the ABC 3 wave down. but however, the upside wasn't that strong. So we do this is a connecting for another double zigzag wave down. So we are on the first wave of the C wave. So the C wave will be elongated. That's for sure. This is the subwave of wave A of C. So we are expecting price to actually hit for rebound between this zone between 70 cents to 98 cents. Okay, so expect price to hit even lower before actually there's a rebound. And I guess even there's a rebound, the rebound won't be that very strong in terms of the I mean a strong bullish recovery. I think price will definitely go in the fall further, but as much as I want to say what is the best price, more data is really needed to actually um, to do further testing and analysis. Okay, so that's for viewers home. Then I'll move on to next one is Maple Tree. So Maple Tree, as usual, I think Maple Tree. I issued a report that I thought that Maple Tree will have a strong upside. But however, I think price actually has already fallen. So it has already invalidated this long bullish hammer reversal signal. So as it's approaching the support as 2.74, I think price will have a high chance of breaking it down. So where is the exact rebound zone? I would think that I'll take a first Q at 50%, which is $2.61, and then followed by $2.43. These are the two levels in the mid to long term. I will look at it for period of accumulation. Okay, so that's it for that, and then number 3, yes, I answered. So OCBC, DBS, and CapitaLand. Okay, so I'll do on DBS. For OCBC, you can refer to my report that is on South BNB. I'll type in the link later in the chat. So for DBS, as well as CapitaLand as well later on. So for DBS, oh, sorry. Okay, so for DBS, there is still we expect some upside to $27. Because first, the C wave is the Y wave or the sub C wave has not been completed of the double zigzag. Okay, so it's the same as the SDI. And then secondly, there's a form of a continuation pattern. Okay, that will actually boost the price further on the upside. And especially today, there's an opening gap of on the higher low because I think the US futures is trending on the bull right now. Excuse me. So all I can say for DBS is that there's definitely a stronger upside. For more information, you can refer to my report. I think it's issued within this month, so it's still valid. I mean, the report is still valid, so you may go and read it. Okay, so I go on to the CapitaLand. So CapitaLand has really broke off the resistance level. It's still in line with my expectation based on a report on early December. So sorry. So price is definitely going to test the resistance zone 1 and then subsequently resistance zone 2. Okay. So other than that, no issue with CapitaLand. So more data is definitely needed. Okay. So let's wait for it. All right. Okay. So thank you. So next one, I'm going to answer. The last one is on SAT Intel, Venture Corp, and HBH Trust. I'm not sure what is that. So if you have the stock code for SGX, let me know. These were 3. So I think I have yes, yeah. So for Venture is still on the ABC larger regular flat correction, but we expect price to actually fall to 1.236 before rebound, or even lower at $17 to 17.22 to 17.44. The reason is because I think we have witnessed a very strong bull run for Venture. However, the bearish flag is actually on still on formation. It just have a pullback recently only, and then we expect price, if price is not going to break 19.25, then we expect the price is going to consolidate further before breaking down to the either support level or zone that I mentioned above, mentioned earlier. So sorry. Okay, so that's for venture. And HPH is HPH. Okay, so HPH upside definitely very strong. Okay, so this is what I call a very beautiful kind of corrective pattern. It's like a flat, and then there's like a potential morning star. Okay, so why I say potential, because the market has yet to close, so we expect price to actually if this is confirmed, we expect price will actually break off the right the bullish flag. But do take note that there is still a bound of resistance between 0.189 to 0.191. Okay, so longer run, I foresee price will actually test 0.225 in the mid to long run. Okay, and I'll take on the last one on sets and Singtel. So let's go to sets. So for sets, okay, sets, there is a like head and shoulder, like I mean previously, but due to like the constant testing and then constant weakening of the support over here, if this is successful, this bull candle maintain its strength by the end of trading day, then we can expect further upside to actually $4.92 to $5 region. All right. Otherwise, I think the bull run is still on still on the continuing run. First of all, this bearish triangle is actually what did I say? Invalidated. So we are on the new extended wave 3. So this is 1, 2, 3, and then we have this is potential wave 4 of the subwave, and then we have 5 to 4.9 to $5. That's the thing that I will look for sets, provided that this candle close on the strong move today. Okay. And then lastly, I'll do Singtel, and then after that, I'll pass on my time to my colleagues. Okay, Singtel is close below the resistance level, expected resistance level that I mentioned earlier, before. So even though that's on the upside, I think I foresee Singtel will actually hit lower back to 2.17 to test, and should 2.17 be broken, then we will see 2.03 to $2 will be the next support zone to have a rebound. But as much as I say that there is a strong support or rebound, but I don't think that rebound will be that strong to actually form a new uptrend, because if you look at Singtel is on a very strong downtrend, is very supported. So this one is very spread out double bottom already. And as such, I think price need to break a lot of levels, and then ultimately $4.56 to confirm the uptrend. Okay, on the larger, very long, elongated, longer trend. Okay, so with that, I'll end off my side, and then I'll pass on my time to my other colleague. Thank you.
Okay, thanks. Thanks, Myron. I'll move on to the next question. To Paul, you mentioned that containers are increasing. So does this demand got to do with Yangzhejiang counter? What is your view and target price for Yangzhejiang? We don't cover Yangzhejiang, but obviously they will benefit. I think about a month ago, they've already announced 7 new containers, and the only thing is, we don't have the demand supply number, so it's hard for me to give you a exact number or how much they can recover. But they definitely, I mean, not definitely, but they should benefit. I mean, if your customer now the rates and they're running out of capacity, there's a bit of shortage, so we should expect some ordering cycle for containers. And one thing to know, all these shipping companies, the mentality, the psychology, if one orders, everyone is hunting for market share. So that is also another trigger for quite another major round of ordering. But again, I don't have the numbers, but on paper they should benefit. I think the November announcement, they already announced some container orders, and I think they were quite upbeat on their outlook for the rest of the year. So they should be a beneficiary. For target price, I think maybe you can ask Viren. Viren, I'm not sure if you have time, but if you want, you can just have a look at the technicals, which I have no idea how it's looking at. Yeah. Okay, the next one. In the coming week, can you cover some quality undervalue REITs with reasonable? Yeah, we will do so. I think. I think for us, if Natalie can comment, I think we still like some of the US REITs. I think that are paying 8 to 9. I think almost 9%. I think she can elaborate more, but that is probably one of our key picks in terms of REITs. Obviously, there's a lot of news about people leaving the office, but even if it does an 8%, I think you'll be compensated for whatever expectations of people not going back to office. Yeah, I think she can elaborate more.
Thanks, Paul. So, as Paul mentioned, yes, some of the US REITs that are under our coverage, Manulife and Prime US, our forward dividend forecast is actually about 9% for both REITs. And also, due to the longer WALEs that are prevalent in the US office REIT structures, the WALEs are about 5 years. This actually means that there's very few, there's lower percentage of leases that are coming due in the following or the next 2 financial years. And despite the fear of hybrid work or remote work, for the US REITs, remote working has already been sort of embedded in their work structure for a period of time, as compared to in Singapore, where the default work of mode has always been at the office. So for these reasons, we do like Manulife, and I think some of our other picks that we like, if you've seen the recent in the recent weeks, Ascendus REIT has been the share price has sort of been trending down, and at this price, we think that it's actually a very good entry price for a very stable REIT. So that will be one of the REITs that are more value and stable in the longer term. Yeah. So I think another defensive play that we like is also Fraser's Centrepoint Trust. So Fraser's, as you know, a portfolio of suburban malls are located within 5 minutes walk of the MRT stations and bus interchanges. So even with phase 3 coming, we do expect that the suburban malls will still remain resilient. Yeah. So I think these are some of our top picks.
Okay, I'll just take the next question on iFast. What is your view on iFast forward after failing to get the digital wholesale banking license? I'll just say something and see if Paul has anything he wants to add on. But for iFast, of course, we do not have a coverage on it. But of course, they have been playing the digital wholesale banking license story for a while now. So some of the valuations have maybe pushed. The valuation has probably pushed it up, the prices up. But of course, after the failure to get the digital wholesale banking license, we see that the share price has fallen off a bit. But of course, first we need to understand that based on their PE valuations, currently it is at a kind of like very high value compared to the industry. But moving forward, what they have going for them is that there is a possibility of them. They are in the midst of applying for this MPF, which is the Hong Kong's version of CPF, investment platform, kind of with another company called PCCW. So if they are able to get the bid and become the platform for Hong Kong MPF system, then of course there will be another booster for them in the short term, but in the longer term, sorry, not the short term. As such, I feel that generally these are the things that are going for them. And they have been also always trying to break into this Greater China market. But we still need to, I think that is the main story that they are playing on, which if it realizes itself, of course, the market is very big and they have a lot of potential to grow there. But in the short term, it doesn't, we do not see it materializing in the short term at least. Yeah.
Okay, we still got a bit of TA, but we have one question on Fortress, but let me just run through. There's another one. It's quite a long question, so I won't repeat. It's about the preference shares for SIA. But anyway, just for info, I really posted in the chat my email sent to SIA and their reply. This perpetuity, my guess for perpetual, okay, the perpetual preference shares, because they're not ordinary shares, so they won't be part of the book value per share, but I'm not sure what is is the exact question. Yeah, but anyway, the answer is there. And if you have any more questions, do send us an email. I think there's a question on Fortress. I think yeah, Vivian, you want to try to help answer that?
Yeah, sure. Thanks, Paul. So for the question on Fortress, the question is, will it benefit from China-Australia trade dispute and hence could increase iron ore supply to China? Will they be better off manufacturing steel rather than selling iron ore? So for this question, yes, Fortress could benefit in terms of from this trade dispute. Firstly, in terms of actually higher iron ore prices, because for due to the trade dispute, there have actually been delays in shipments at the ports in China. So this is also partly a reason why iron ore prices have been higher. And the next thing, whether they could increase iron ore supply to China, I also think that, yes, according to the first half results, there have been ocean freight charges recorded. So yeah, I do think that they have been supplying iron ore concentrates to some steel mills in China. But for the bigger picture, because Australia accounts for more than half of China's iron ore imports, and this China iron ore imports, this whole volume is about 1 million tons. So it is expected that going forward, China is still likely to remain very reliant on the Australian iron ore for the foreseeable future. Otherwise, 50% of its import volume wouldn't be available. Yeah, and back to Fortress, they have also been actually placing more focus on domestic demand. So, for example, in September this year, they inked an offtake agreement, which is that they agree to supply this iron ore concentrate to domestic steel mills. So, all in all, for the first part of this question, yes, they could benefit from this trade dispute and maybe increase some iron ore supply to China. But for the second part, will they be better off manufacturing steel rather than selling iron ore? I do not think so, because the expertise of the management lies within iron ore mining projects, and it is different from manufacturing steel. So that would be a no to that question. Yeah, thank you.
Yeah, okay. There are a few TA question. Well, you want to take this one? Is Philip's recommendation for G.H.Y, Terence?
Yeah, okay, so I'll chime in for the G.H.Y question. I think we don't have a view on G.H.Y. We attended a briefing, and for them the challenge will be the reopening of concerts in China. Right now it hasn't restarted yet, so the concert in terms of hosting concerts, it's not going to be up yet. We also don't know when it will be up, and but the TV production is already, they've restarted TV production, and the launch of all those kind of filming but because we again everything that we know is in from the prospectus so we don't know anything more, and don't have a recommendation on the counter also at this moment.
Thanks, Hans. Next one, target price near term for Nano. I guess if you want technicals, maybe, but I guess the history is quite short. But I really no idea anything. I really know not much. Limited understanding of nanofilm, so not right for me to kind of try to answer this. You have a buy rating for Kofu with expected return of 16%. Any reason why it's not one of Phillip Absolute 10? Yeah, I think for us, Absolute 10 is there's no right or wrong. It's just that we try to balance the portfolio, and we try to put the larger cap stocks in there. This so-called Absolute 10 is our so-called model portfolio. So the only small cap we had was Propnex, and it just that it was very unusual. We rarely put any small caps because we don't want to make this portfolio so volatile, right? But the only reason why I put Propnex is because the economics of the business was just so unique, like 50% market share. So that's why we included. Otherwise, we typically try not to put any small mid cap, number one, and number two, we put large caps and we try to balance it. It's a bit more, I mean, understandably, it's a bit more boring, I guess, in that sense, and some might want to say that, but we try to keep it to the large caps and not to try to inject any like major more cyclical or smaller cap names with only very rare exceptions. I hope that answers it. Commodities. Yeah, you say you're optimistic on commodities. What's your take on Bumi Thermal, my first research? For me, it's more the industrial commodities. Not so much the plantations and so forth, but just that if you China is undergoing. If you look at some of the credit numbers, there are major re-leveraging underway in China. Then you have a housing boom in the US too. So these are some of the factors why we think, at least thematically, industrial commodities rather than plantation and so forth. I mean, that's just our view. But again, it's very macro view. Let me think on what is one construction stock with the highest upside potential. By the way, my style is value and contrarian. If I had to play the construction industry, I think again, this is just our own view. We don't have coverage. We'll probably be Pan United. I think that we highlighted many times. We prefer the building material stocks. So Pan United, is trading near 5-year, close to 5-year lows. It's not 5-year low. 5-year low, I think 23, 24 cents. I'm looking at the chart now, but provided by the SGX. So the 5-year low is about 24 cents. Now it's about 28.5. So I guess if you want to talk about value and you're playing a stock where they got market share of 40-50%. So we like that. I mean, we like to buy those that the economics is strong. The economics of the business is strong. So you just have to wait for it to iron out. Of course, now cyclical downturn. I mean, whole construction sector has collapsed. So for us, construction sector, better way to buy is just the building materials. Number one, the market share is so huge. Number two, you don't need to worry who is the eventual winner of any. You don't have to worry whether they get this contract or that contract, because whoever gets the contract, they have to take an order from Pan United. Again, we don't have coverage. I'm just telling you, since we know them for many years. I hope that helps. But if you want a construction stock, I think the biggest should be Lendlease, if I'm not mistaken. Yeah, right, Terence. I think Lendlease is the biggest construction stock out there.
Yeah, correct.
Yeah. Okay, I hope that helps. Viren, you got time to take on some more? Or?
Yeah, definitely. I have some time. So okay. I think I accidentally answered I think this one was a question on Mapletree Logistics, because I thought Mapletree the one I did was industrial. So as to compensate, I'll do logistics before I move on to the other companies. So for logistics trust, not bad. Okay, so there is a potential morning path. And then right now, if you look, we do have falling wedge light pattern. Although some
You're sharing screen. Sorry.
Sorry.
Yeah, two at the steps.
Okay. Yeah, I'm so sorry. My screen was off. Okay, so anyway, now what I mentioned earlier was for Mapletree Industrial Trust, I think there's a potential morning star first of all. And then there's a falling wedge, so it kind of like indicate a strong bullish reversal again. And then resistance level of 207 to 210 region. Okay, and then somewhere is lay upon 1.84 to 1.89 key support zone. However, I think some of you guys may think that this is a descending triangle, but first of all, I won't take, because I think price has broken 2 candles out of the immediate support. Okay. Yeah. So and another thing, price actually has already attempt to break out of the falling wedge already. So I think for Mapletree Logistics Trust, we can see near-term upside to test 2.1 back to $2 region, and then back to 2.07 to 2.10 level. Okay. So we expect that. Okay. So for the next one is Fraser Logistics Trust. Okay, so for Fraser, I think Fraser, I really have not much views on that. First of all, despite there's some sort of wick engulfing, and there's a pennant. I think price will actually have further upside to test around $1.42, and then before breaking up to $1.50. So in this sense, I think Fraser Logistics, we really need more data. So the best way I can think of is price immediately gap up above 1.45, then we can confirm the trend. That's like provided it's not an exhausting gap, definitely. So Fraser Logistics, more data will be needed, but all I can say that the trend ultimately is still on the upside with the Ichimoku showing hinge of ranging market. So during the ranging market, Ichimoku is really, I would say that is really not much. You won't be able to trade much on that. You won't be so powerful as compared to the trading market. Okay, so then followed by the Suntec rate. Okay, Suntec rate. Okay, Suntec rate. This morning we have a very strong upside, and then we have a bullish running triangle. Okay, but the main problem is the main issue is that 1.51 to 1.54 resistance zone is currently being tested, and then even now before lunch hour we really have a sell down over there. So if price by end of the day do not close above this resistance zone, then we can foresee further downward testing to support zone at 1.38 to 1.41. Okay. Then lastly, I think this is a favorite topic of all. I think the glove company has been trending lower. So I warned before that if should price really fail to break below 3.10 to the top resistance at 3.18 to 3.20, then we face a potential double tree corrective wave. So in this case, it's a very special case. We have a 5-wave broadening wedge pattern, a bullish continuation pattern, of course, but I think price is going to break lower first. So why do I say so? This support zone at 2.11 is being tested 1, 2, 3, and then this one a fourth time, and then there's like a short fall. It's like a bearish rectangle, or you can say a bearish panel over here. So price is going to break lower, and then we're going to see the first support zone that is going to be tested over 1.55 to 1.72, that's for sure, and then followed by the 1.14 to 1.25 region. Okay, Ichimoku is showing a very strong bearish three depth bearish cross already. So top level is definitely bearish. And on top of that, if you look at that, we have WX and then we have Y. So Y wave can be either, or the E wave of the broadening wedge can be either 1.59 to 1.72 or 1.14 to 1.25. Okay, lastly, I'll go into Yangzijiang. Yangzijiang, since the start of since April until now, it has been ranging for the longest time. So it has already got into a sub triple three zigzag wave already. So I foresee some more downside, and then to 0.820 before a rebound to above 1.13 to 1.16. Okay, so Yangzijiang seems like dying off, but the momentum seems like slacking off. So it's really very hard to predict where Yangzijiang will go next. So Yangzijiang has been trending wave very long already, ranging for very long already. So okay, so that's all for me. So let me check is there any last question to do it. Okay, I'll do city development. That will be the last one before we close out the session. Okay, so city development, there is like a cup and handle, which I mentioned in my report in I think 2 weeks ago, I can't remember. But the only thing is like is that if city development is able to break $8.10, that would be the best case scenario. Just like what CapitaLand. So you observe how CapitaLand has really break the resistance level and then go way up, and then it's on the way to test the next resistance zone 1 at a higher level. So same thing for city development. So we expect price to actually hit up to 8.68 and then subsequently to 9.22 region. So provided 8.10 is going to break. So today is a very strong candle. So we have a V-shape continuation pattern, a light, or you can take it as a ascending triangle. So if this is broken, then we can confirm the upside. All right. So With that, I close on my presentation. Paul, do you have anything to,
okay.
add?
Just one last. I finally got one easy question, so let me just answer that. Thank you, Ms. Lim, for an easy question. For Singtel, should we opt for scrip shares or cash dividends? So the answer is cash dividends. I think because the scrip is in 2.4422. So if you take the scrip, you are actually overpaying for the shares. Because the share price now is 230 something like that. So thanks for that. Finally, someone asked me a easier one. But anyway, we need to end it off because Weiren has a US one. So on behalf of Phillip Securities Research and Poems, thank you everyone for attending, for all your questions. Sorry we couldn't answer everything. We apologize for that. Just park it in the stocks BNB. We'd like to thank you all for attending here today, for all your questions, and we wish everyone a very prosperous and more importantly a healthy 2021, and we hope to see you again next year. So thank you everyone for attending, spending time with us, for all your patience, and we hope to see you again next year. Thank you everyone. Bye bye.